In April and May 2025, Japan's government bond market boiled over. Yields spiked, liquidity vanished, and a market known for decades of engineered calm abruptly entered a chaotic phase shift. This chart shows the yields for 30-year and 40-year Japanese government bonds. You can see the exact moment the 30-year yield spiked 100 basis points in just 6 weeks, while the 40-year yield shot to a record 3.675%. Classical financial models struggled to explain the severity of this rupture, but a specialized systems theory diagnostic published in May correctly identified the mechanics before the worst of the collapse. The analysis described the Bank of Japan's exit from yield curve control not as a standard interest rate adjustment, but as a system-wide attractor shift. Institutional analysts assumed the central bank could orchestrate a manageable withdrawal from a decade of quantitative easing. They modeled a smooth transition. The market's violent reaction proved those classical economic models are structurally blind to the mechanics of high-complexity financial crises. Classical economics operates on a specific assumption. Financial markets are mechanisms designed to discover an underlying objective truth, like fundamental asset value. The Bridge 360 Metatheory discards that assumption entirely. It is a framework that analyzes global finance using the laws of physical thermodynamics and systems theory. This diagram contrasts the two frameworks. Left, classical models lock on to a static truth point. Right, the Bridge 360 model navigates a flowing entropy corridor. Seeking perfect information is computationally impossible. The truth-seeking system shatters under overwhelming data. The entropy-managing system flows around obstacles. When data is this dense, survival depends on steering through the current rather than building an exhaustive map of the riverbed. Success is measured by the ability to maintain movement within safety limits while using finite resources. In this light, intelligence, whether in markets or machines, is the capacity for navigability. Systems do not survive by being mathematically right. They survive by keeping their internal chaos within manageable boundaries. The Japanese retail carry trade offers a material laboratory to test this metatheory. Observers often use the term Mrs. Watanabe as a demographic nickname for housewives trading foreign exchange. In reality, it operates as a highly potent cultural token that compresses a complex strategy into a simple rule. This schematic visualizes what Bridge 360 calls rule of inference memetics. Financial strategies operate as physical, replicable memes, broken down here into an identity meme, an inference meme, and a transmission channel. The specific inference meme driving this trade is simple: borrow yen at a very low cost and use it to purchase higher-yielding foreign assets. This rule went viral because it drastically reduced the cognitive and computational burden for everyday investors. It was easy to copy, which gave it high memetic fitness. Brokers, digital trading platforms, and financial media acted as transmission channels, accelerating the meme's replication across the population. Financial architectures are built on this memetic fitness, how easily an instruction replicates, rather than the objective, long-term mathematical safety of the underlying trade. This simplified carry trade rule rapidly replicated, saturating millions of individual retail accounts in markets across the globe. When an inference rule replicates this fast, it can enter a state of memetic pathology. The rule spreads so quickly that it begins to shed its necessary risk conditions. As the trade copied itself, investors deleted the critical caveats. They ignored the risks of currency exchange rate fluctuations, the dangers of leverage, and the physical impossibility of everyone exiting the trade at once. The aggregate mass of these replicated trades creates reflexivity. The physical volume of the positions alters the actual market environment the trades rely on to survive. When volatility returns and millions of identical, caveat-free positions attempt to unwind simultaneously, the global debt architecture chokes. Exit congestion triggers a severe fragility event. Complex financial systems collapse when a conditionally rational trade turns into a memetic virus, ultimately destroying the specific environment required for its survival. This same memetic framework scales up to the apex institutional level, the sovereign bond market and the Bank of Japan. For decades, global finance relied on a central institutional inference meme, the absolute belief that the Bank of Japan would indefinitely absorb debt and prevent bond prices from falling. This diagram maps out the mathematical core of the Bridge 360 metatheory. It represents the unified probability space on a normalized interval from 0 to 1, where 0 is perfect, rigid order, and 1 is unnavigable chaos. The epsilon spine is the narrow, navigable corridor of system stability, located strictly between the 0.45 and 0.65 thresholds on this spectrum. Under yield curve control, the Bank of Japan artificially forced the government bond market to stay pinned within this stable spine through persistent trillion-yen market interventions. The meta-theory argues that physical thermodynamics, biological ecosystems, and financial markets all operate inside this exact same entropy geometry. Market stability is a function of successful temporary confinement within that narrow entropy corridor. It lasts only as long as the operator can hold the system inside the spine. The system was deeply perturbed the moment the Bank of Japan withdrew from yield curve control and transitioned to positive policy rates. Because interventions had suppressed normal market signals for years, the market had lost its capacity to accurately price risk, resulting in immediate informational turbulence. A mimetic war followed. Rival narratives, ranging from automatic capital repatriation to imminent sovereign collapse, aggressively fought to replace the old belief that the central bank would always intervene. This diagram shows the consequence of that mimetic conflict on the system's stability. Without the structural braces of central bank intervention, the bond market violently oscillates, tracking its normalized entropy eigenvector. The oscillating market breaches the 0.65 threshold of the epsilon spine, blowing out into the unnavigable high-entropy zone. This is an entropic blowout. Classical economics frames these transitions as periods of smooth price discovery. The data shows a systemic rupture of the operating architecture. Standard models failed because they track price. Complex crises are determined purely by a system's failure to maintain its entropy bounds. Japan's bond market is not just an isolated system, after all. It actually serves as the foundational layer of global finance. The global financial architecture operates as stacked attractor layers. Government bonds sit at the base, trade policy occupies the middle, and global equities rest at the top. These stacked layers draw from a central gauge representing a shared global entropy budget. Forcing artificial stability in the base layer depletes it. Pinning the bond market into rigid order forces extreme fragility upward, fracturing the top layers, the volatility paradox. Ultimately, validity is entropy stability, not truth. Financial engineering and institutional strategy require a new mandate. Planners must abandon the search for objective prices and focus entirely on mapping mimetic fitness to enforce the bounds of the epsilon spine. In a hyper-complex world, survival belongs to those who abandon the illusion of perfect control and master the physics of their own governance.